big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities.
A great way to achieve your financial goals, pay your bills, or have extra money to spend is to increase your passive income each month. In this video, we will take a look at different ways you can make $2,500 a month in dividends and how much money you need to get there. So firstly, let's get into how much you need in order to make $2,500 each month in dividends. Because if earning $2,500 each month is your goal and you're starting from zero with a new account, this milestone will likely take some time to achieve. Here's how to set up a portfolio for passive income so you can get $2,500 in dividends each month. To make $2,500 a month in dividends, you need to invest an average of $1 million in your portfolio with a 3% dividend yield. The exact amount of money you will need to invest to create a $2,500 per month dividend income depends on the dividend yield of the stocks, but for this example, we are using 3%. The dividend yield is the return on investment for the stocks you buy in terms of dividends. To calculate dividend yield, divide the annual dividend paid per share by the current share price. You receive X% in dividends back for the money you invest. Target dividend yields in the 2.5% to 3.5% range for regular dividend payments. Adding more stocks with greater dividend yields to your portfolio could seem like a quick way to achieve your goal, but it is potentially risky. Higher dividend yields could be a sign that the company is having problems. For example, in this discussion, all math will be based on a 3% dividend yield and focus on quarterly stock payments to keep things simple. Most dividend stocks pay dividends 4 times a year. To cover each month of the year, you need to buy at least 3 different stocks. 3% is the middle of the regular dividend stock target dividend yield range. If each payment is $2,500, you'll need to invest in enough shares to earn $10,000 per year from each company, or 4 times $2,500. Per year, your portfolio will generate about $30,000 in dividends. To estimate how you'll need to invest per stock, divide $10,000 by 3%, which results in a holding value of $333,333. And then multiply that by 3 for a total portfolio value of around $1 million. Not a small amount of money, especially if you're starting from scratch. And at that total value, you'll likely want to invest in multiple stocks, so spread the risk. Investing in the stock market always has a degree of risk involved. Now let's take a look at some of the ways you can make $2,500 in dividends. One of the most popular options, and also probably the safest option, is to invest in a dividend-paying ETF. There are thousands of ETFs that provide dividends, but in this video, we will go through some of the most popular ones. An ETF, or exchange-traded fund, is a type of investment fund that trades on stock exchanges, similar to individual stocks. ETFs are designed to track the performance of specific indexes or sectors, providing investors with exposure to a wide range of assets in a single investment vehicle. Usually the ETFs provide a group of stocks. Also, many ETFs offer dividends, and some are even specialized in dividend-paying stocks. ETFs usually offer less risk than, for example, individual stocks, and that's why buying an ETF is the safest option for most people. The most popular dividend-paying ETF with over $40 billion in assets under management is the Vanguard Dividend Appreciation ETF, ticker symbol VIG. The average dividend yield of this ETF as of today is 1.7%. VIG is known for its focus on dividend growth stocks, aiming to provide investors with exposure to companies that have a strong history of increasing dividends over time. The expense ratio of this ETF is 0.06%. The dividends are distributed quarterly. The amount of money you need to invest in VIG to generate $1,000 in dividends depends on the ETF's dividend yield. Currently, VIG has an average dividend yield of 1.7%. You would need a portfolio size of $1,764,706 in VIG to generate $2,500 a month in dividends. Another great dividend-paying ETF is the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. The fund seeks to track the performance of the Dow Jones U.S. Dividend 100 Index, which includes high dividend-paying U.S. companies with a track record of consistently paying dividends. This ETF has $27 billion in assets under management and an average of 2.98% dividend yield. You would need to invest $1,006,711 in SCHD to make $2,500 each month in dividends. The expense ratio is 0.06%, and the dividends are distributed quarterly. The last ETF I have decided to include is the iShares Select Dividend ETF, ticker symbol DVY. This ETF tracks the performance of a basket of high dividend-paying U.S. stocks. The ETF has $19.7 billion in assets under management with an expense ratio of 0.38%. The expense ratio is a lot higher than the other two options. The average dividend yield for DVY is 3.33%. To make $2,500 a month in dividends with this ETF, you need to have $901,000 invested. A lot less than, for example, the Vanguard Dividend Appreciation ETF. The dividends are distributed quarterly. And by the way, if you have made it this far into the video, hopefully you're finding it helpful. Make sure to subscribe and leave a like on the video so you don't miss any of my future videos related to investing and finance. Another way to earn your dividend income is by buying individual stocks. This is a common approach for generating dividend income. There are thousands of different companies that offer dividends, but some are better than others. In some cases, the company that offers a lower dividend yield is better than the company who offers a high one because of the risks attached to the high-yielding company. A good place to start when looking at dividend-paying companies is the S&P 500 Dividend Aristocrats Index. The Dividend Aristocrats are a group of companies that have raised their dividend for many consecutive years, often 25 years in a row or more. These companies are usually large and stable companies that are often a part of a major stock market index, such as the S&P 500. These are safe options for people wanting to invest in dividend-paying stocks. A negative that's important to note is that these companies are often large and well-established, so the room for growth for these companies is usually not as big as for some smaller companies. So when looking at these companies, keep that in mind. Some examples of these dividend aristocrats are Johnson & Johnson, IBM, and Target. Johnson & Johnson, ticker symbol JNJ, has a long history of paying dividends dating back to 1944. The company has increased its dividend every year since 1968, making it one of the dividend aristocrats. Johnson & Johnson's dividend has been growing steadily over the years. The company's current dividend yield is 2.9%, which is slightly above the average dividend yield for the S&P 500. J&J is a well-established company with a strong track record of dividend payments. IBM, ticker symbol IBM, has a long history of paying dividends, dating back to 1916. The company has increased its dividend every year since 1985. IBM's dividend has been growing steadily over the years. The company's current dividend yield is 4.61%, which is above the average dividend yield for the S&P 500. Target Corp, ticker symbol TGT, also has a long history of paying dividends. Their dividend history goes back to 1966. The company has increased its dividend every year since 1984. The company's current dividend yield is 3.23%, which is above the average dividend yield for the S&P 500. The third option we will look at in this video is investing in bonds. Bonds are fixed income securities issued by governments, municipalities, or corporations to raise capital. When you invest in a bond, you're essentially lending money to the issuer in exchange for regular interest payments, or dividends, and the return of the principal amount at the bond's maturity. Here's how you can earn dividend income through bonds. Bonds typically pay periodic interest payments, often referred to as coupon payments. These payments are fixed and predetermined, providing you with a steady stream of income. The coupon rate is the annual interest rate that the bond promises to pay. For example, if you have a $10,000 bond with a 5% coupon rate, you would receive $500 in annual interest income. Some bonds are structured to pay interest in the form of dividends, especially preferred stocks and certain convertible bonds. While not all bonds pay dividends, these types of bonds provide regular dividend-like payments. It's important to note that dividend stocks and dividend bonds differ in several ways. Dividend stocks represent ownership in a company, and the dividends can fluctuate based on the company's performance. On the other hand, bonds represent debt, and the interest payments are generally more stable. There are various types of bonds, including government bonds issued by national governments, municipal bonds issued by local governments, and corporate bonds issued by companies. Each type has its own risk profile and potential return. Make sure to subscribe and watch the other videos on the channel for more investing and finance-related content. See you soon.